I'm watching in awe and seeing what's happening in Europe. We had the EU summit last week where we saw a little bit of resolution, and then we saw quite a bit of optimism, and then a sudden referendum that was called by Greek Prime Minister George Papandreou with regards to the next bailout package with 130 billion euro. What is this going to do to sentiment going forward? Because the markets are not taking it very well at this point.
Right. Well, I think the key thing to recognize is we didn't really have a proper agreement last week because there were no details. It was not clear where the bailout money was going to come from. And you see that although the equity market reacted well, bond markets, Italian yields continued to rise. So it was clear that there were some downside risks. The Greek referendum announcement simply introduces a new element of uncertainty, and that's very difficult to estimate what the impact would be, other than to expect more volatility.
More volatility, perhaps a default. Is that what we can start expecting? And after all the negotiations and the summits and the dialogue that has occurred in Europe, we've kicked the can down the road. Can we expect a default going forward?
So we believe a default is imminent and drawing closer, and we've actually, as far back as March 2010, we published notes saying that, you know, investors should sell Greek bonds because we saw the story as unsustainable. You have orderly defaults and you have disorderly defaults. There's a huge difference between the two. A disorderly default is pretty disastrous in terms of contagion. And Greece seems close to that kind of scenario.
And when we say contagion, can we expect this to filter through in all equity markets? And we know that when we watch the JSE and the way that you know, South African markets perform, it's really at the mercy of the sentiment that emanates from the US and from Europe. Can we expect equity markets across the board to come under significant pressure?
So we would see contagion certainly through all the natural links, equity prices, bond yields, currencies. And there's no market that is insulated from that kind of initial contagion.
With regards to safe havens, you know, we know that Switzerland has embarked on very interesting strategies to try and make sure that its currency does not strengthen over a certain points against the euro. Central banks have tried to intervene with their currencies. What is your sense in terms of the best place to put your money right now? Is it gold? Is it going to Switzerland, despite the fact that we've seen so much intervention by the Swiss National Bank?
Well, one of the things to consider about Switzerland is it's a small economy with a huge current account surplus. So this money keeps driving up the currency. And although the currency has been too strong of late, if you think 3 years down the road, 5 years down the road, you're going to have a stronger Swiss franc. Shorter term, though, this is unlikely to happen, given the authorities' determination to defend a certain level for the currency. Because if the currency gets too strong, no factory can produce, no factory can export, and that then becomes damaging.
Well, Costa, would you be putting your money into the Swiss franc right now? Where would you be parking your money?
Well, so for me, it's a no-brainer.
Okay,
I live there, and I would buy the Swiss franc, so that's clear. But the
even
issue,
at these levels?
Yes, for me it's clear. But I would say that for investors that are looking shorter term, the risk is more of a somewhat weaker Swiss franc, given the extent to which it's strengthened. And
we know that the perceptions of risk started changing dramatically with regards to the impact it would have on emerging markets, and we know we've experienced very strong flows. What kind of impact will this dire scenario that we're actually talking about have on South Africa and overall emerging markets? Do you expect very strong outflows out of the local currency here?
Well, the first thing to recognize is that Europe is heading for a very substantial slowdown. Recession probably in the first half of next year, and Europe is an importer of commodities. This will have a negative effect on emerging markets, on commodity exporters, and will have a negative effect also on emerging market currencies shorter term. So we should see high volatility in those markets.
Are we expecting, in other words, a double dip across the board globally?
No. Not a double dip globally, for the simple reason that there are pockets of the world that are still growing, mainly in Asia, also in Latin America. We don't expect a double dip in the US, but Europe is the big risk now.
Do you think the Eurozone is going to break up?
No, short term, because the cost of a breakup are simply too high, and therefore people will do whatever they can to try and muddle through as long as they can. 5 years down the road could be a different story.
Very quickly, how do you view South Africa, UBS? What is the UBS view on South Africa?
So the view is that within the emerging market space, South Africa is relatively defensively positioned for the simple reason that the currency trades freely, doesn't appear overvalued, and this helps within an emerging market context.